So welcome everyone. I know more people are joining. I see more people logging in, but I do want to get started. I can, I believe, see questions. So if anyone has questions they want to ask, feel free to type them in to the console, and I should be able to answer them along the way. And I'm just going to keep an eye on them as I'm speaking. So first of all, I just want to make one point clear for anyone who's not aware. This trading platform is a full service of AvaTrade. With AvaTrade, you can use MT4 or MT5. You can use Ava's trading platforms that are based on MT4 and MT5, like AvaTrade Go and Ava's Web Trader. And there's also copy trading available with AvaTrade. And you have this platform called AvaOptions. Once you open an account with Ava, you can add an AvaOptions account, just like you can add MT4 or MT5, and trade away in this platform. We do not offer binary options. In case any of you are looking for binary options, first of all, we don't offer them. We've never offered them, and I would steer clear of them. But these are vanilla European style options, which is the norm for options trading. The options on foreign exchange is the largest options market in the world by far, in terms of volume, in terms of participants, and pretty much in terms of all measures. The FX options market is very large. So this is the standard product that we offer, and we'll be discussing today. So let's get into this presentation. I'm going to just a couple of quick introductions. You need to get familiar with these types of diagrams that we're going to use. Sometimes they're called a hockey stick diagram. This is a profit and loss diagram for a transaction. Let's assume that we're going to trade euro dollar. On the x-axis across the from left to right, we've got, let me just pull up my laser pointer. Where's my laser pointer? Sorry, one moment. Here we go. Here's my laser pointer. So across the x-axis here, we have the euro-dollar rate. As the market goes up, means the price of euro-dollar is going up. And if it goes down, the price of euro-dollar is going down. And on the y-axis, we have the profit and loss of a trade. So in this transaction, in this picture, I'm showing the generic picture of what happens when you buy euro-dollar. Not options, just euro-dollar FX, which you also might call a forward because you're buying euro-dollar FX and then you're rolling it over every night to have it into the future if you like. If the market goes up, you have unlimited profit potential. If the market goes down, you have unlimited loss potential. That is how the FX market works. That's basically how any market works. Any asset, when you buy it, price goes up, you'll make money. Price goes down, you lose money. You're only limited in losses by stop loss orders or by closing your position, or if you run out of margin in your account, your position may be automatically closed. Same thing on the upside. The only thing stopping you from making unlimited gains is yourself closing the position or placing a take profit order. It's the main picture here. The main point is that when you buy foreign exchange, you are facing symmetric risk. When the market goes up, you have unlimited profit potential. When it goes down, you have unlimited loss potential. Let's compare that to buying a call option. When you buy a call option, you have the right to buy an asset at the strike price, which is here. So I'll use a pen. You have the right to buy at the strike. Why isn't it writing? Let's put on this pen. Well, I don't know why it's not writing, doesn't matter. You have the right to buy at the strike price, which is here. If the market goes up, you will exercise your right, and therefore you will have unlimited profit potential, just like in trading FX. However, if the market goes down, if the market finishes below the strike price, you walk away, you have no further obligation. You are not obligated to buy euro dollar at the strike price. So your maximum loss potential is what you paid for the option. That's called the premium. So the main takeaway from this is that options, when you buy an option, have asymmetric risk. On one side, we have unlimited profit potential. On the downside, we have limited losses. The most we can lose is what we paid for the option. Okay? We have other presentations about this, so I'm going to go through these very quickly. The other type of option that we offer is a put option. A put option gives a customer, the buyer, the right to sell an asset at a known price. So if you think the market is going lower, you have two choices. You can just trade FX, trade the asset, which means going short the asset, so that if the price drops, you can buy it back later at a lower price and make profits. That is your unlimited profit potential on trading the underlying asset, like Eurodollar. And if the market goes up, you have unlimited loss potential, the mirror image of the previous page. If you buy a put option, similarly, you have the right to sell at the strike price. So if the market goes much lower, you'll exercise your right to sell at the strike, and you'll buy back in the market at a lower price, giving you unlimited profit potential, minus what you've paid for the option, which, as we said on the previous page, is the most you can lose. What you paid for the option is your maximum loss. Another way to use options is to sell them. We can sell a call option. Selling a call option exposes you to unlimited loss potential as the market goes up. But it's still better than the forward trade or the spot trade. In both cases, if I go short Eurodollar or if I sell a call, if the market goes much higher, I have unlimited loss potential. But if I sold the call, I'm going to earn this premium. The difference between these two lines is the premium that I earned up front. If the market does not go higher, or if I say if the market does not finish higher than the strike, I get to earn this premium. I get to earn the money that I took up front for selling this option, for taking the risk. So again, we have asymmetric returns. The maximum I can profit is the premium that I received on this option, and the maximum loss is unlimited, only offset by the premium that I took up front. Same thing for selling a put option. Options can have any strike. So the strike, the right to buy, could be the right to buy at the current price. It could be the right to buy at a higher price. It could be a right to buy at a lower price, which is in the money. If Eurodollar is trading at 117 today, the right to buy at 115 is going to be very expensive, because if I have the right to buy at 115 that's already trading at 117, we're already 2 points in the money. That's very expensive compared to the right to buy at 119, this blue line, where the market needs to go much higher before you can have any profit. Now, why do we use options? As those pictures show, options give you asymmetric payoffs. Combinations of options, bought and sold with different strikes, give you the opportunity to express your market views. It's not just, I think it's going up or I think it's going down. You can say, I think it's going up, but I'm not sure. I don't want to be exposed to all that downside. So instead of buying Eurodollar, I'm going to buy a call option. I don't have a lot of money to spend. I'll buy an out of the money option. I'll buy a short dated option. I think another way, if you think the market is not going higher, you don't have a particular view that it's going to go lower, but if you think it's not going higher, sell a call option and get paid premium, earn money upfront, which is analogous to being like an insurance company. Insurance company collects premium from the buyer in exchange for covering risk. An insurance company sells a driving insurance, car insurance. If the driver has no accidents, the insurance company's happy and keeps the premium. Same thing here. If I sell an option, I'm giving someone else protection against risk. Somebody has perceived risk. I get paid for that. Options let you trade with less emotional stress, because you can buy an option and wait until the end of the option period. If you buy a 1 week option, you can pay your premium up front. 1 week later, check where the market is. You still own that option. Whereas if you went outright and bought the market, you might have been blown out because the market dropped before it went up and met your expectations. Unlimited gains with limited risks. You control your exposure. And as we've spoken about, you can sell options to earn income, which is something you cannot replicate in the spot market. And lastly, I'll say options traders have more fun. You'll just have to start trading options to believe me. I'm going to skip this page. This wasn't supposed to be here. I'm going to skip these pages. We're going to go straight into the app. So let's talk about options strategies. On the earlier pages, and again, feel free to type in some questions. I am here. I am keeping an eye on them. If you have some questions, I will do my best to answer any questions, as long as you don't ask me about who's going to win the US elections. I'm going to pull up the app. Actually, let me pull that app back up again. Here is a nifty little program that I just got to share the app on my screen. Okay, let's log out. When you first load the app, it's going to look like this. You're going to have a login screen. If you don't have an account yet, you can register for an account either in the app under sign up and get a demo account, or you can sign up for a real account, or you can go in through our websites. I already have this account. I'm going to log in. It's going to load information, and then the screen is going to flip horizontally like that. Our app is rather unique. We have a horizontal design because we think it gives a better opportunity to show unique features of options. So here it looks like any other trading platform. I can scroll up. I can see different products. There are the equity indices, for example. If I want to add more products, I just click this editing button, and I can mix and match and get rid of things. Like delete that one, click save, and I can reorder and do whatever else we'd like to do. On the right side of the page, we can scroll across and see more information about the markets. This is implied volatility information. Implied volatility is a measure of the price of an option. Higher implied volatility means the market expects more market action. Therefore, the option price will be higher. An option on gold is more expensive than an option on Euro Sterling or Euro CAD or Euro Swiss in particular, because it's more volatile. More volatile, more chance for the market to move, more chance to make money. Here are the implied volatility numbers behind those charts, and you can look at 1 month options, 2 month, 3 month, whatever you like. We have a whole series of other videos, as I've mentioned, so I'm not going to dwell on this right now. On the next screen, we have Autochartist. Let me just quickly do this to get rid of this bar on the side, this annoying bar. We have Autochartist Signals. We have a whole video or a series of videos about Autochartist and how it's integrated into our platform. But this is automatic chart pattern recognition, giving trading signals for the underlying assets. For example, you see bearish signals in the 30-minute candles in the pound against the dollar. And then you have information about the pip size and leverage, which is generally 100 to 1 outside of the EU. In the EU, leverage for retail traders for options trading is 100 to 1. For spot trading is limited by regulation to 33 to 1. So using options to express your views, you'll have triple leverage with options if you're an EU retail trader. Let's continue by getting into strategies. And I'm going to use the app here. I'm going to go to the trading page. I just clicked on the pound against the dollar, since that's got a lot of action lately. And this screen is showing us trading spot. I clicked the sell. Let's click the buy instead. This says if I buy 100,000, I can do this. I can write on the screen, 1 sec. Here we go. If I buy 100,000 of the pound spot, if the market goes up, I'm going to make money. If it goes down, I'm going to lose money. Right? This is showing us 1 hour of history. I can see 1 day of history. I can add information to the chart by clicking up here, like moving averages and Bollinger Bands and fractals and stuff like that, if that's your game. I can see my profit in dollars. This is a dollar account. I can also see it in price. So this is the same units as the underlying. And if I was trading some other currency pair, I could see it in other currencies as well. If I go short the market, I'm going to lose money when the market goes up. I'm going to profit when the market goes down, right? That's going short. You can adjust the screen very easily. So that's our picture, because there's more things that we can do than just spot. We have options and option strategies. So let me show you some information about option strategies. How do I kill this thing? Here we go. We have all sorts of option strategies. We already covered spot, which is the underlying asset, buying FX, buying or selling. The underlying is the straightforward trade, but we also can buy or sell calls or puts. We already reviewed those. But by combining buying and selling calls and puts, we can access all of these other strategies, and that's why we're here today. So let me first show you what a call option looks like in the platform, because this will help you understand exactly how this all works. If I buy a 1 week, up here it says the expiration date is 1 week, I can choose 1 month. If I buy a 1 month call, do this again, I'm buying a call, you see here on this button, I'm buying a call, it's going to cost me $1,752 to buy a 1 month, that's 33 days, a 1 month call at 129.25. That's our strike price, 129.25. I have the right to buy at 129.25. If the market goes up, as we discussed earlier, market goes up, we can have unlimited profit potential. If the market goes down, the most I can lose is what I paid for the option. So in red, you see at expiration, when this option expires in 33 days, the most I can lose is what I paid for the option, which is shown here on the buy button, which we haven't bought yet, $1,733. If the market goes up, I can have unlimited profit potential, and I can kind of scroll down and you can see it's unlimited profit potential. This orange line is showing us the P&L of the option today as the market goes up, how much money we can make today. I can click on this button, not this. I click on the horizon button. Watch that yellow line on the P&L. As time goes by, the option approaches the expiration value. So at expiration, my profit and loss looks like this. The most I can lose is what I paid for the option. The most I can profit is unlimited. Today, this is what the profit and loss of the option strategy looks like in the yellow line. Now I can grab this handle and I can trade an option that's out of the money, for example, or I can buy an option that's in the money. So if I have the right to buy at 123.50, that's going to be very expensive because it's already trading 6 points higher than that. So it costs $6,000, or if I put here in price 60, it costs 6 points because we're so deep in the money. If I buy an out of the money option, this one only costs 47 pips, right? Much cheaper. If I sell the option, it looks like this. So this is that same hockey diagram, the same picture that I showed you earlier, but I've turned it on its side. I think I can rotate the screen. Yeah, let me do that again. Rotate. Hey, we're upside down. Okay. You can see this this picture, the red and green. Oh, let me make this bigger. There it is. The red and green, you see this diagram looks like what I showed earlier. On the right, market goes up. As spot goes higher, I have unlimited profit potential. If the market goes down, the most I can lose is what I paid for the option. Let's go back to where we were. Now let's click that strategy button again and say puts. There are puts. If the market goes down, I have unlimited profit potential when I buy a put. If I sell a put, I have unlimited loss potential. Okay? And just very briefly, this white arc and the shaded areas that you see between the current spot price and the expiration P&L, these are showing us potential market movement. The white lines are showing us what 2 standard deviations of movement over the next 33 days looks like. It's just showing us a reasonable range to expect for the market over the next 33 days based on option pricing. This is framing the risk of the trade so that you really see the risk and reward trade-off of an option. And the risk and reward is very intuitive, I think. If you look at all this red area and balance it against the green area, it looks like a fair deal, right? The unlimited profit against the limited losses looks like a fair deal. If I have an out of the money option, I have smaller chance of getting to the green, therefore it costs less. This balance between red and green makes intuitive sense. So that's why we like to show the range this way. So you understand that with options, it's all about probabilities. It's all about risk versus reward, okay? So I'm going to continue. Let's look at some strategies. Actually, I'm gonna move to our presentation. No, sorry. If you click here, the strategy guide, everything turns blue, and you can learn more information about each strategy. So what is a call spread? A call spread is a bullish trade. When you buy a call spread, you're buying one call and you're selling a higher strike call. As you see right here, it's moderately bullish because it has limited upside and limited downside. The risk is limited, the reward is limited, very small impact on volatility, and time decay. So the change in the value of the options as time goes by is very limited, and it depends on where we are compared to the strikes. You think that looks interesting, you click try it. So what is a call spread? This is our first strategy. Instead of just buying a call, this is a two-leg strategy. The idea here is if you just buy a call, it's going to be rather expensive. Let's say we look at this 1 month call struck at 127. It costs 320 pips, because remember, it's already in the money. If you think that's too expensive, you don't want to spend that much, you might say, I'll give up some of this upside in exchange for a cheaper price. So what I'm going to do is I'm going to kind of cut off my upside by selling a strike right around here. Let's sell a strike at 131.40. I'm going to click a call spread and do that same option. It was a 127 call that I'm going to buy, and I'm going to sell this 131, let's say 131.50 call. Now, instead of costing 350 pips, or whatever it was, 320 pips, now it only costs 240 pips. I have balanced my risk and reward. I now have limited downside because I've bought a call, but I've sold off some of my upside. I've sold a call up here. So again, you see a very clear and clean balance of risk and reward, the red versus the green, rather than having unlimited profit or loss potential when trading the underlying just by buying Eurodollar. We now have limited profit and limited loss. So this is a bullish trade, but with limited risk. So that's one of our first strategies that we can talk about. I've got a diagram here. These are all the option strategies, and I've highlighted what one would typically use for a bullish strategy. Bullish means that you think the market's going to go up, whatever asset it is that you're going to trade. Somebody, sorry, just a quick question. Someone is asking if we can switch from a candlestick to a line. Of course we can. That is here. We have a simple line chart, like with an area like that, or we have a line chart like that. And you can have open, high, low, close, or candles. And we can do things like add a simple moving average. I'll make it purple. And let's make it a little bit thicker. There's a moving average, whatever period it was that I chose. So let's get back to the presentation. I've highlighted bullish strategies. So the normal bullish strategy, the obvious one, is trading spot. Just buying, you think the market's going up, buy the pound against the dollar. Very simple. Another way we showed is just buying a call. The third way we showed was a call spread. It's still bullish, but now it has limited risk and limited potential, but it costs less. It's all fair. And the fourth strategy that I've highlighted here is called a call ratio, A call ratio, what is a call ratio? Let's just go to the tape. A call ratio, whoops, strategy guide, call ratio, is selling one call and buying 2 higher strike calls. We're going to get some extra leverage. And the goal here is you've got, again, known risk, known downside. You see this picture? You have known maximum downside, unlimited potential upside, and you can really take more of a view saying, I'm willing to take more risk at the current spot level because I think we're going higher. Let's do an example. I've got 2 things I can play with here. I'm selling a low strike call, which is in the money in this case, and I'm buying 2 higher strike calls. So I can use this, for example, for a 0 cost on the downside. I'm willing to take some losses around the current market level because I really think we're going to go higher. And this is a great way to power up your leverage because now you're going to own these calls cheaper. You're going to own this upside. So this is another common strategy. Back to here. The other bullish strategies that we have are a risk reversal, seagulls, not the most commonly known trade, and a synthetic forward. So let me just talk about the risk reversal and the synthetic forward here. I am going to keep this presentation to under an hour, by the way. What is a risk reversal? Let's go right in here. Strategy guide, risk reversal. A risk reversal is almost the opposite of that call spread, because in this case, we're going to buy a call and sell a put. So we're going to take unlimited downside risk because of that put. And we're going to have unlimited upside potential because I bought a call. But what's the great thing here? I'm buying this call and I'm financing it. I'm paying for it by selling this put. What do I mean? Let's try it. I'm still looking at 1 month options on the pound. Let's say I buy a 132.75 call. It's going to cost me 50 pips, 0.005. And I sell a 125 put. I sell the 125 put, I'm going to earn 50 pips, 0.00506. So this is effectively free. The most I can lose between the strikes is pretty much 0. However, I'm bullish here. I'm so bullish that I'm willing to take this unlimited downside risk beyond 125. Not before it, but if we finish below 125, I'm okay. In fact, my view here is I think we're going higher. And if it really goes lower first, I'm okay with that. I'm willing to buy. I'm willing to buy at 125. We're trading right now at 129. I'm happy. If we go down here, I'm willing to buy at 125. It's okay. So I'm okay with this risk on the downside, right? I'm okay with this risk, and I'm using it to pay for this upside. That is called a risk reversal. And why is it called a risk reversal? Because you'll often use this in conjunction with a position. Suppose you already are short eurodollar. Okay, you sold eurodollar and you want to hedge it. So you want to limit your downside risk or limit your upside losses. So if I'm short the market and the market starts going higher, I might want to buy a call to hedge against this market move higher. So I'm going to buy this call and I'm going to sell the put, which effectively converts my trade into a call spread. We can go over that separately if you like. Let me get rid of that. Now, again, as I change the strikes, different things are happening in this relationship between profit and loss. I can put my strikes closer together. I can move them further apart. You can do whatever you like. And of course, we can also sell the risk reversal, which means I'm taking a bearish view. The market stays where it is, nothing really happens. If the market goes down a lot, I'm going to win. If the market goes up a lot, I'm going to suffer losses. Now, notice the yellow line, which is showing us our profit and loss today as the market moves higher and lower. The red and green are at expiration. So where are we standing 1 month from now? But today we're on this yellow line. This yellow line assumes that options volatilities are unchanged, which is kind of the normal assumption. Volatilities could go higher or lower, so this yellow line is not perfect, but this is what we get if implied volatilities are unchanged and the market moves higher and lower. If I click horizon, as time goes by, my exposure is going to eventually approach the terminal values. And so when we get to expiration, the yellow line, the horizon line, matches, of course, the red and the green. Okay. Buying and selling. And of course, we can change our expiration date. You can either choose a specific expiration date that interests you. All these blue dates are available to you. Or you can choose a standard tenor like 3 months or 6 months or 1 week or even 1 day. Okay. There's 1 week. Automatically shows us that 2 standard deviation range again, so we have to adjust our strikes a bit. If you're an advanced user and you understand a lot about delta, I can long press on the handle and I can either type in an exact strike. I don't have to use the ones that were offered to me. I can choose any strike as long as it's between, basically within bounds, which means between a 5 and a 95 delta, between a 5 delta call and a 5 delta put, or I can define my strikes according to these terms, which means that I can say, let's say I want a 33 delta option. 33 delta option roughly matches or roughly means that I'm choosing a strike that has a 33% chance of finishing in the money. An at the money option has approximately a 50 delta, or an at the money forward option has a 50 delta, because we're at the money. Either we're going to be higher or lower at expiration, 50-50 chance. Right? The market already reflects all known information, 50% chance of moving higher, 50% chance of moving lower. That's what delta is telling us. So I can explicitly enter the requested delta, or I can choose delta neutral, which is like a 50 delta. I can choose the at the money strike. I can choose the at the money forward strike. We've got various choices in setting the strikes, or just use the handle, which is the more fun way. Let's move on. The other strategy I want to talk about is the synthetic forward. Now, I mentioned, especially for you traders that are based in the EU, if you are registered with AvaTrade EU, with options, you get extra leverage. Options are not covered by or explicitly excluded from the regulations that limit leverage in Europe. So if you're trading FX and you're in Europe, generally you have 30 to 1 leverage is the maximum you get for trading spot. But if you use options, we can give you 100 to 1 leverage. So how do we do this? Let's look at the spot trade. Okay, buying spot, we said earlier, looks like that. Market goes up, you make money. Market goes down, you're going to lose money. Synthetic forward looks like this. It looks the same. With a synthetic forward, you're buying a call and selling a put at the same strike. You see, we have one handle here for 2 options. If you buy a call and sell a put with the same strike, what's happening? It means when we get to expiration, if the call is in the money, you're going to buy. So you're long the market. If the put is in the money, then somebody who bought that put from you is going to put the asset to you. So you're going to buy it again. So you're either going to buy it because the put gets exercised, or you're buying because the call gets exercised. Bottom line, a synthetic forward, buying a call and selling the put, is the same thing as a forward trade. It has the same symmetric exposure as just buying the underlying FX, and then you're paying overnight interest if you roll FX. When you use a synthetic forward, you're buying in the future. You're buying at expiration. Of course, you can always close your position any day at any time from the market open on Sunday night or Monday until the market closes on Friday. But you get to do it with options, which gives you extra leverage. It also lets you trade the forward, which can be more efficient than buying FX and then paying overnight interest every night. If I go short, it means that I am selling a call and buying a put, but the exposure is symmetric. If I make it longer dated, here's 6 months, still symmetric. And what happens over time? Still symmetric. Okay. Your exposure is known. Doesn't really matter where you set the strike. It has the same economic value, so there's no difference in your profit and loss potential, pretty much. Just a little bit of bid-ask spread might change. The only difference is whether you're going to take cash up front. If I set my strike low, that means that I'm buying an in-the-money call and selling an out-of-the-money put. I have to pay for that. If I set my strike high, I'm going to receive cash up front. Doesn't really matter because you have to post that as margin, but that's what's happening when you move your strike. Most people doing a synthetic forward will set the strike very simply at the forward like this, at the money forward or at the money or delta neutral, just somewhere near the money. So that's a great strategy to know about, especially if you're in the EU and you are looking for additional leverage. So those were our basic bullish strategies, but there's another set of strategies on this page that are also bullish. Whoops, what happened there? You see. These, in red, I've circled the put series. If I sell a put, that's also bullish because selling a put says, I think the market is not going down. I either think it's going to go higher, but it's not going lower. So selling a put spread, and selling a put ratio are also bullish transactions. Let me show you. Put. Remember, buying a put is bearish. You buy a put, you profit when the market goes down. But if I sell a put, it's bullish because I'm profiting when the market goes higher. My profit is limited. It's not the same thing as buying a call. It's a different view. But it is saying, I don't think the market's going down. I think it's going up. Maybe it'll stay here. It kind of depends on where you set your strike. If I put my strike like this, definitely bullish. If I sell a deep in the money put, this is bullish, not taking a lot of risk. If I set my put at a very low strike, I'm not taking a lot of risk, so I'm not earning a lot of premium. If I sell my option at the money, I get a lot more premium because I'm taking a lot more risk. All very intuitive. I can earn $3,000 up front for this 1 month option at 128, for a 6 month option, sorry. If I sell a 1 month option at 128, I only earn $1,200. See the difference? I've adjusted because the range for 1 month is somewhere between 123 and 135. My range for 6 months is much broader, 116 to 142, which is kind of crazy. If you don't think it really is going to go that high, well, super, sell the put. Sorry, if you don't think it's going to go that high, you can sell a call. So we can take that kind of a view into your strategy. You can use strategies to express these views like, I don't think it's going to go that high. I don't think it's going to go that low. You can't do that trading the underlying, trading FX. Only options give you the flexibility to take any view into account. I think it's going to go down, but then it's going to go higher. So I'll sell a 1 week call and I'll buy a 1 month call. All these different combinations that you can do give you profit potential to meet any view. Bearish transactions. We can sell spot, of course, just sell the asset. We can also buy puts, buy put spread, buy put ratio. We can sell the risk reversal, sell the synthetic forwards, sell the seagulls, right? So I'll just pick one. Well, let's see. Well, I think we already showed this basically. Let's continue. We don't have a lot of time left. Please do feel free to ask questions. They're not coming in fast and furious. Let's see, somebody made a comment about Trump. I'm not gonna repeat it. Thank you very much. Okay. This thing is really hard to use. Just one second, I'm trying to pull out this question. Here we go. I've got a question. Someone gave me a nice compliment. It's nice that it automatically calculates profit and loss. I agree. It's my design. And someone asked, does the UK count as in the EU for this purpose? Absolutely. So far it does. And I think that it will continue to be in the EU for this purpose. As far as leverage goes, we have no indication that the FSA is going to treat options any differently than ESMA, the European regulator, has suggested. Okay, let's continue. Other types of strategies we didn't speak about are volatility strategies, straddles and strangles, butterflies and condors. To impress your friends, you can always talk about executing condors or iron condors. What are these things? If you think the market's going to be more volatile, you just don't know if it's going to go higher or lower, but you're expecting more action than what's already priced into the market. Okay? If you think the market's something's happening, maybe because of equities, maybe because of elections, maybe because of Boris, you think something's going to happen, you might want to buy volatility. You want to profit from big moves. What do they look like? Let's click on it. Let's choose a straddle. What is buying a straddle? Buying a straddle means you're buying a call and a put. Before, remember, the synthetic forward was buying a call, selling a put. Here we're buying both options at the same strike. It's called a straddle. I'm straddling the market. I'm going to win if the market has a big move up or if it has a big move down. But be aware, on this strategy, you're paying up. You're paying for two options, but at the end of the day, only one of them is going to finish in the money. When we get to expiration in 6 months in this picture, or let's just choose 1 month. When the market gets to expiration, either we're going to be higher or we're going to be lower or we're going to be right here, but you're not going to win on both options. We can't be in two places at once. So this is expensive. This is a strategy that you use typically for a short period of time. I'll buy a straddle, events are going to happen, and then I'm going to sell the options back and take my profit, because otherwise I'm going to be I'm risking all of this red zone, all of this potential loss. If I click on the horizon, as time goes by, I'm going to get sucked into that vortex and pay all that premium, pay all that time decay. Now, on the other hand, if you think the market's not going to be as volatile as the market expects, if you like the break evens, sell it, right? Now, but look, you're taking risk on both sides of the market, but you're getting paid on both, and you can't, at the end of the day, okay, at expiration, you cannot lose on both. You'll only lose on one. But from day to day, if the market decides the market's going to become more volatile, you have exposure here to the overall level of options pricing moving higher. You have exposure to the implied volatility moving higher when you're selling options. But as time goes by, you're going to earn that money. So if you're right and the market stays right here, you're going to earn that money, earn that income. Put this back. Now, what if you say, I don't like this. This is too risky. I'm not willing to take exposure both on the upside and the downside. That's where things like the Strangle come into play, or a Condor. A Condor uses 4 options. Woohoo! The Condor lets you, actually, let's choose the butterfly. I'm sorry, let's choose the butterfly instead. The butterfly is a lot like the straddle, except we're going to buy protection on the outside. I'm going to change this to 3 months. I'm going to buy some protection on the outside. So I'm selling the call and put in the middle, but I'm going to buy protection on the outside. I'm not willing to take unlimited risk. Now, this doesn't look like a great strategy. I don't like the relationship between the red and the green. I think this is just costing too much, and I don't think it's a great strategy. But what I might like is something like a Strangle. Let's say I buy a Strangle. Strangle is just like the straddle, but now you have 2 strikes. I'm going to buy a call, buy a put, but they can have different strikes. And like before, remember, you can only win on one of them in the end, but you get to set the levels that work for you, or you can sell them and take in that premium You're selling 2 options, but if you can wait all the way to expiration, you can only lose on one of them. Okay. Now, someone is asking a question about timing. If I bought a 1-week option, and which expires 1 week from today, which is the 22nd, do I have to wait till the 22nd, or can I close it when I have a profit? The answer is you can close it anytime you like. In fact, I can buy these options right now. Let's do this since we're running out of time and I haven't shown you yet how to trade. Let's click buy again. When I click buy again, I get this confirmation window saying, if you click execute, you're going to be buying 100,000 of this Strangle. You're buying a 133 call. You're buying a 124.50 put. You're paying $2,500 because this is a dollar account. This is how much margin you're going to need. Now, I have other positions in this account. That's why margin is coming into play. If I had no positions whatsoever, I'm only buying options. I don't need any margin. Buying options, you pay for the option, that's it. No margin required. You say you like this trade, click execute. And in a moment, it'll be done. We've been on here a long time, so it got stale. If you like, this trade is done. If you like this trade, you can click share and you'll get the standard Android sharing screen, and you can share it with your friends using WhatsApp, your Gmail, whatever you like, right? This is, and when you do that, you're gonna get a link that you can share to your friends, and then they'll be able to follow and do the same kind of a trade. But let's get rid of that. And let's see this trade. We bought a 133 call and a 124.50 put. If I click here, account value, I get my account summary. My account summary is telling me all of my positions, my net position in euro, my net position in the DAX, my net position in the pound. If I bought the pound against the dollar, it means I'm long the pound and short the dollar. So I'm seeing my net risk by currency. Here I can see it by currency pair. Here I can see my exposure to volatility, my options exposure. If I click down here, open positions, I can see all of my positions. Looks like I'm not sorted here. There we go. So here are the trades that we just did. We bought a 124.50 put and a 133 call. These are my order numbers. I can see when I traded it, what was my cost, and what's my live P&L, which is coming from the bid-ask spread. Okay. And further on, you can see things like total delta, total vega, total theta. We'll cover that in another webinar. Where was the underlying, why I opened it? Where is it now? What was the implied volatility, or sorry, what is it now? If you want to close it, just highlight the trade. You can either highlight multiple trades like that, or just one of them. Let's say I only want to close this put. I click close, and it comes right back to that same screen. I can't change my strike anymore. It's showing me my unrealized loss of $103, and now I can close it. Or I can close half, or I can close more. Let's say I want to close half, close, execute. And I'm closing it because let's say I had already made money. And now when I go back to this page, you see I only have 50,000 left. Quick and easy. Let's say on the other 50,000, I want to leave a take profit level. So I have 50,000 left. I want to put in a limit. I click the word limit. You see this here on the right side? Click the word limit. And now I can say, if the market goes higher, I want to sell. So if I can get $4,300, or more accurately, 870 pips for this thing, I want to take profit. And it shows you how much money you'll make if you hit this level. It shows you how much money you'll make if it happens today. Sorry, it shows you basically where spot needs to be to reach this level today on the yellow, or expiration in the green. So this is kind of nifty. So I'm going to put in a sell limit, confirm. This goes to the servers, and there it is. I bought this put. I have an order to close it. I can scroll this over and see that it is a limit good till close, to close it at 678. So again, risk manager shows me my net risk for each asset. So in the pound, I'm long 207,000 equivalent of the pound. I'm long 210,000 from spot, from trading FX, and I'm short a little bit from options. In dollar CAD, I sold spot and I'm long from options, so my net exposure is short 50,000. History button shows all the trades we've done today, or you can choose a range. You want to see all your trades from a different period, you click apply, it'll go and grab them for you. You can see all the trades that I've done here. Closed trades shows me all the trades I've closed and how much I've made or lost on them today. So you got everything here at your fingertips in a mobile app. Kind of neat. You can deposit, withdraw. Again, over here, you've got access to all kinds of tools. For example, you can find the economic calendar, Autochartist, which you saw in other places as well, watch list configuration videos, strategy guide, bring that up again, what's a put spread, and you can scroll across, look at the different strategies. There's that Siegel. You're welcome to investigate that one later. What does selling it look like? Buying it, selling it, try it. Sticks it right in there. It looks like my strike went off the screen somewhere. Little bug. Deal with that later. Okay. So that is that's the platform. There's the Seagull. We've got basically a call spread with an extra put, or you can call it a risk reversal and selling a call. Lots of different names you could give this thing, but that's the general strategy. Limited upside, unlimited downside. Flip it the other way. Limited downside at the top, unlimited here. Great ways, again, to use this call spread to finance owning this put. So this costs me nothing. I'm taking limited risk if the market goes much higher for unlimited profit potential as the market goes lower. And again, you can close it anytime, or you can hold it to expiration when you're there. So we are basically out of time. I want to thank everyone for joining us. This is recorded, and so by the end of the day, most likely it should be uploaded to the AvaOptions YouTube channel. Thank you for joining me. There's lots of other things there. Do play with this mobile app. I love it. It is my baby, but I think it's terrific, and I really think it helps you visualize risk and see the whole proposition of an option, to basically understand very clearly and visually risk versus reward and how time impacts the value of an option, etc. Thanks, everyone. Have a great day. Good luck trading. We'll see you in a couple of weeks for the next webinar.